Great. Hi everyone. So today I'm going to be sharing a quick run through about what's happened on the US stock market last week. And then we'll move on to talk about the dollar and some other interesting ideas for your sectors and companies. So we finally had a bit of a sell-off last week in the stock markets. And this can be attributed to two main factors. So firstly, with data releases from many governments saying we are indeed in recession, this news flow has sort of caught up with the fundamentals that we talked about last week. And that being the important point being that the cash flow is weak for many of these companies. And the central bank Okay, so now moving on to the dollar. So the dollar is the most used currency in the world, and the numbers on this vary, but it makes up for about 60% of currency in circulation right now. And 80% of world trade is also done through dollars. Sometimes this can peak to levels of up to 87%, such as in the aftermath of the 2008 GFC. So why are the numbers so high? Why is so much trade done through dollars? Well, this is because the dollar is the global reserve currency, which means it's seen as safe, stable, and highly liquid. So it's almost a winner-takes-all scenario, because the more countries that accept the dollar, it means that this further bolsters the dollar's own reputation and liquidity. So liquidity is very important. So if I'm a corporate trading with my factory in Mongolia, for example, I don't really want to be paid in Mongolian togrogs. Nothing against the lovely Mongolian people, but the currency is just not liquid enough, and it's also highly volatile. So what we can do instead is transact in dollars, which on a relative basis is much more stable and highly liquid. So I can change my dollars back into pounds, and it's relatively easy. And indeed, this is what most businesses do, including the ones that you might be analyzing. So you can see the value in researching the dollar and why it's highly significant, especially if your company partakes in international trade. Now, we can assess how important this is on a company level by asking who buys your products, and therefore how much dollar exposure do you have. So for example, McDonald's has a highly significant amount of overseas sales. So they fall into this category here, where a rising dollar is actually quite bad for McDonald's, because once they convert their profits in other currencies back into dollars, they're going to lose out. And then you have also American exporters will also suffer. So just as imports become cheaper, then exports become more expensive. And although you might think this is mainly just at the margins, last year, a lot of companies such as Procter & Gamble, Harley-Davidson, Caterpillar, all warned investors about the strong dollar affecting their performance. Okay, so now moving on to where we think the dollar is going. So there's two main camps in this, and I am summarizing extensively here, but we have the bullish case presented by Brent Johnson's dollar milkshake theory, and we have the dollar bear thesis, which is mainly just on the premise that it's quite intuitive. Quantitative easing increases supply, shifts supply to the right, therefore the price goes down. So just to explain Brent Johnson's case a little bit here, we have this slosh of liquidity that's been created over the last 10 years from QE programs all over the world, from central banks such as Japan, England, Australia. Every central bank has followed through with this. And this slosh of liquidity is your milkshake. And then this liquidity is funneled into the dollar. So it's sucked up by the dollar straw, which is the fact that the US has relatively higher interest rates compared to most G10 countries. So for example, if I'm a bank and I have a lot of yen, I can either get a negative yield on my Japanese government bonds, or I can put that in treasuries where I'm going to get something back. So that's the main thesis behind this. Everyone wants to get a bit of that dollar interest. So all of this demand for the dollar causes the dollar to strengthen. This then causes havoc with a lot of emerging markets. because most emerging market debt is denominated in dollars. So as the dollar goes up, these interest payments become more expensive. And this might mean that the country might have to default on their debt. And then the supply curve actually shifts to the left, because if you think about issuing debt, so if you think about it, issuing debt expands the money supply. So if you withdraw that debt, you're withdrawing that supply as well. And this immediate withdrawal of dollar supply is much more than the decrease in demand of those interest payments. So that means that the value of dollar will go up because supply goes to the left. And it becomes this positive feedback loop. So the more the dollar strengthens, the more these countries might be susceptible to default, which then further strengthens the dollar. On the other side of this coin, we have the theory that all this QE from the Fed, so they announced this $3 trillion stimulus, this is going to increase the supply of dollars. So the supply shifts to the right, and therefore the value of the dollar goes down. So this is very intuitive, but the problem is this works very well in a closed system. But when we live in a global economy right now. And if you think about it in a global sense, then it doesn't really work, because the demand curve for dollars also shifts to the right because of factors such as relatively higher interest rates. And then combine this with the global supply of money increasing, then your net flow into the dollar is now suddenly that much bigger, which is what we talked about earlier with the Brent Johnson's milkshake theory. And I think the dollar bull thesis is more credible and probably play out in the next 1 or 2 years. And then after that, you might see this blow off top, and after that, some sustained weakness with the dollar as countries get tired of a strong dollar and come up with alternative solutions instead. Okay, so now just moving on to some other ideas. With the dollar, I think it's, if I think the dollar's bullish, I'm just going to go long USD and short some EMFX. I'm not really going to reflect that in an equity trade. It's just more something to consider, especially if your company has high USD exposure or is based in an EM country. But these other ideas I've listed here are much more translatable into stock plays. So this is all about taking an idea. So for example, many people in the 2000s would have had the idea that the internet's going to take over the world. And based on this idea, they would have translated that into a stock play, such as buying Amazon. So these are ideas that are much more easy to translate into a stock play. The first one is the growing trend towards digitization. And we talked about this last week, but the companies that are implementing tech faster are the winners, and the ones that don't will be the losers. So a good example is Walmart. They can attribute much of their success from implementing a data science cloud throughout the company. And what that did is it linked all their inventory and sales data. So they know much more about consumer trends, and they have much more efficient inventory management than all of their peers. And you see similar things being done with Uber. That's just a data science cloud with cars on the end of it. Airbnb, that's just a data science cloud with rooms on the end of it. And during Corona, McDonald's, they've kept up with the tech trends. So that's allowed for outperformance to their peers, such as the traditional restaurants that don't have these options. They haven't kept up with the trends. Next, we have industry consolidation. So one thing to consider is when a lot of these small businesses, if our thesis plays out with the insolvency, they're going to go bankrupt. And that means for larger companies with the healthier balance sheets, they will survive. And that means that there's going to be a lower concentration of the market, and the remaining players will have much more pricing power. So you can see this happened towards the end of the 2008 downturn as well, where these remaining incumbents, because of their price setting power, they're going to have abnormal profits going into the future. So that can be a great investing opportunity if you manage to find some companies you think can weather this storm. Next, there's commodity prices. So it's important to check how much of your company's operating costs are linked with oil. One great example I'd give is in the mining industry, oil can make up to 40% of production costs, depending on the metal. So it's highly significant. And when you combine the idea of low oil prices, which we currently have, with the bullish conditions for metals such as gold, then you can then see that mining is an incredibly lucrative opportunity right now. Finally, we have policy impacts. So there's potentially a direct effect on companies such as Deutsche Bank, where the ECB might have to buy all their bad assets and eventually nationalize them. And you can see the Deutsche Bank share price has just been crushed recently. A more indirect impact could be that, so after all of this fiscal stimulus, it actually turns out that Americans will have more disposable income this year. So you could think about where this money's going. Well, over 1 million Americans signed up for Robinhood trading exchange accounts over lockdown. And a lot of this is because there's no sports on, there's nothing to bet on. So a lot of people decide to punt at the markets. And all of this customers means lots more commission for the retail exchanges, and they've done really well recently. So that's another idea to think about. There's other big ideas such as the reconfiguration of supply chains away from the US and more towards Asia, but that's quite a big subject, so we'll go into that in a separate video. But for now, I'll hand it back over to Sean for the DCF modeling.
Perfect. Thank you. Thank you for that, Ken. And before we get started on intrinsic valuation, I think you had a question. Do you want to cover that now, or should we wait till the end? I think it was from Matus. He said, Goldman is short the dollar. Don't you think with zero lower bound interest rates, this could mean that we should be bearish on the dollar? Do you have any opinions on that?
Sorry, what's this? Goldman short the dollar?
Right. Yeah.
Well, yeah, you can make the case both ways, but the thing is if you look at it from the interest rate basis, the dollar's still much more attractive than all the other G10 currencies. Do you know why the dollars announced they're short in the USD? Because if we look at more of a reasoning, I just personally think this reasoning provided by the relative interest rate stories is just very compelling. Mm-hmm. And then you combine that with it's the world reserve currency as well, and it's a safe haven. Whilst we're in this crisis with Corona, you can see a lot more capital going to the US, and the US stock market looks more attractive, which also attracts dollars. So I can see a lot of cases for the dollar being bullish. Mm-hmm. Maybe we can go more in depth and explore the arguments for the bearish side another time.
Okay, yeah, that's great. So we've had the interesting part of the presentation now. I'm going to try my best not to put you to sleep, and we're going to go through intrinsic valuation, which is there's three ways of valuing a company. So the first kind is relative analysis, relative value, which is where we look at comparable companies. So this is similar logic to saying if you're valuing a house, we can look at our neighbor's house and what they're worth. Intrinsic valuation is where we value something based on the cash that it will generate in the future. So if we stick with the housing analogy, we could analyze the rent that we could receive over the next few years together with what we plan to sell it at. So discounted cash flow analysis is where we account for everything that a business can generate in the future together with what it's worth after that period. Then we account for what we're entitled to as shareholders and the time value of money. So when you buy an equity stake in the business, you are limited by what you pay for the stock. However, so if you're the equity holder and the company were to go bust, then we're going to be the last people to receive money back from the company. So the debtors will have the first claim on the assets. And I don't want to go into too much detail on this, but I would like you to have a read of the Investopedia link that's at the bottom of the slide, and I'll share the slides with you after this. So the second nuance in the discounted cash flow analysis is this idea that $1 is worth a different amount at various points in time, which we're going to come back to a bit later on. So since I don't really want to overload you with too much information today, we're going to be focusing mainly on the income statement and how this plays into discounted cash flow analysis. So the other two statements are the balance sheet and the cash flow statement. The balance sheet gives us a snapshot in time of what the company's assets, liabilities, and equity looks like, while the cash flow statement shows us material changes in cash split into three categories, which are the operating cash flow, which is the core operations of the business, the financing cash flows, which is the cash flows from raising equity or raising debt to finance their operations, or taking out a bank loan, and then investing cash flows, which is to do with investing in capital that they need to run their business. So for example, property or brands or other businesses. So since I'm going to focus on the income statement today for shorthand modeling, there's some extra detailed links also. And the other two links are also important. So I would like you to have a read of those before next week. And that's to do with the balance sheet and the cash flow and how all the three statements link together. So you've probably heard of the term, the top line, which in the income statement refers to the revenue that a company generates. And generally, when we're talking about the income statement, we're going to be working our way from the revenue down to the bottom line. And the bottom line is the profit that we can take away. But we like to split it up into different permutations to explain where the costs fall within the business. So I'm going to take you on to the next slide. So gross margin is the next step down from revenue on the income statement. It shows us the direct cost of producing the goods that we're selling. We can use these margins as an efficiency measure, and they're useful in comparing similar businesses. Margins are always going to be calculated as a percentage of our revenue. So by comparing these margins between businesses, we can often figure out where we need to research further. So I'll give you an example. Say BMW is consistently earning a 10% higher margin or higher gross margin than Ford, then we should ask ourselves the question, why are BMW's cost of goods lower than Ford's? Is it to do with the location of their suppliers? Is it to do with the types of materials they use? Or is it to do with the kinds of cars that they're building? And is this a valid comparison? So you should always ask yourself that. We can also ask, is this sustainable? If they are comparable, is there anything that could change this going forward? And these will all feed into your valuation of the company. So the next line down is the operating margin. And this shows us the fixed and variable costs that a business incurs. So put simply, fixed costs are what we are going to incur anyway. So we're talking rent, or we're talking costs that we're going to be paying maybe on a monthly basis, maybe wireless costs or costs to keep your phone running. And variables are things that vary with the output, so how much we actually produce. Again, we can use these margins to compare across similar businesses. And often there's a lot of information if we can get a bit more granular than just operating margin. And we can often glean how well a company is being managed by looking at their operating margin. And it helps to break it down a bit further to see which items contribute the most towards the operating costs. So typically the categories within operating costs are going to be general and administrative, salaries, rents, and then overheads. And you have to remember that in financial markets, there are hundreds of other investors who are just as smart as us, who are also putting money behind our opinions. So you have to figure out why the margins are different. And I really want to stress this point. Are the companies comparable? And often you can see these nuances and differences reflected in the valuation. And before you make a statement that a company is mispriced because of different margins, you really want to understand why they're different and whether they're comparable, and then what contributes towards them being different. So now I want to look at the next metric, which is called our unlevered free cash flow. And I'm going to take a step back again and take you back to what we're actually trying to do. So we're doing an intrinsic valuation where we're forecasting the revenues and the money that we can make by owning this business over a set number of years. And we want to account for everything that all of the costs we're going to incur as an equity holder. So if we come down to the operating margin, we've accounted for all of the money they can make within the regular course of business. Now we want to calculate our free cash flow, which takes into account all of the costs of funding the operations within capital, and then our interest payments and debt also. So there are multiple ways that a firm can fund their operations. Either they issue equity, they issue debt, they take out a loan, or they fund with the cash generated from their operations. We want to adjust our money earned from these core operations for the other items that we need to generate our cash flow. So we're adjusting it so that we have also our material cash changes. since this is what we're interested in as an equity holder. So the first point I want to cover is depreciation and amortization. So this is how much our assets are going to lose in value per period. And once you have a read of the balance sheet article, then you're going to see that this is to do with the property that they own or the brand that they have. So basically things that they need to facilitate their operations. For example, Nike may depreciate the value of their factories since they can produce less with that same factory each year that it runs. We also have to deduct our tax as well, as most businesses pay tax, unless you're Amazon, you have your operations domiciled in Ireland, but we're not going to go into that. So when you're looking at this figure, you want to have a look at what percentage are they actually paying on their earnings before interest and tax, and then compare this to the effective tax rate that they should be paying in their domicile, or based on the country that they report in. And there's a bit of complication to do with tax deductible interest, but we're going to come back to that next week since I don't really want to overload you. So when you do come to forecasting this line item in tax, just make that small comparison and try and it's always better to take the higher and then maybe see how it changes as you go forward. Working capital is the next line item, and that's the amount of available capital that a company needs to fund their day-to-day operations. And you can calculate this as their current assets minus their current liabilities. Capital expenditure is the amount that businesses spend on creating this capital that they need to operate. So for example, we mentioned before, how much are they spending on building factories, or how much are they spending on acquiring this machine that they need to build a certain product. So for simplicity's sake, if you do once you get to this point of forecasting, you can use a percentage of sales, and we're going to come into a bit more detail how to properly analyze all of these items in a discounted cash flow next week. But try to look at the trends in the figures and forecast based on that. There are much more sophisticated ways of doing this, but since we're just trying to get an idea of how what contributes towards a valuation of the company, we can allow ourselves to be a little bit inaccurate for the time being. So now I want to look at the residual value of the firm. So up till this point, we've accounted for everything that we earn by operating this business, and then all of the other costs that we incur in order to generate this cash flow. So now we want to look at the residual value of the firm. So think about it, right? If we forecast 5 years into the future, there's not a hard border that says that this market value is going to fall off a cliff and be zero once we pass this threshold. So we want to look at some kind of residual value of the firm. And I'm going to define a couple of things before I show you how to do this. So first of all, I want to mention what is enterprise value. So enterprise value is the total amount that we would have to pay if we wanted to buy a company's equity and debt. And EBITDA, it follows that that's a valuation metric in terms of the money that they're generating before depreciation and amortization, interest and tax. And then there's another link for you to have a read of over there. The next definition I want to give you is the terminal value. So this is the steady state value of the business. So the value of the company once we pass this threshold. So remember, once we complete the valuation of these cash flows into a certain period in time, the business doesn't cease to exist. So we want to figure out the value to us as a shareholder once we pass this threshold. So we can figure out our terminal cash flow, if you will, by taking the EBITDA from our last year of our forecast and then multiplying it by our EV/EBITDA multiple. And you may ask, what's the point of doing this? And I mentioned before, we don't want to forecast a firm's cash flows forever, and we've already made a lot of simplifying assumptions. So the terminal value is a way of getting around that. And in order to find your enterprise value EBITDA multiple, you can look at comparable companies, and then you can look at a sensitivity analysis. So you can say, if we were to use this EV/EBITDA multiple in the future, then this is what our terminal cash flow would be. And then this is how it would affect our valuation. Okay, so I hope you're all still with me. And I want to give you a brief, again, a brief roundup of the points that we've covered. So we forecasted our cash flows for a few years using the income statement and then adjusting it for costs of financing and assets. Then we figured out the residual value of the company after X number of years. So now we need to account for this idea that a dollar is worth a different amount at different points in time. So it's all about this idea that money is eroded with inflation, and there's this opportunity cost of investing in something and having it grow. So for analyzing an equity, we need to account for, one, the risks of being invested in this business compared to others, and then two, the time value of money. So the fact that my dollar now is worth more than it is in the future. So for this, we use a weighted average cost of capital, which put simply weighs the opportunity cost of equity and debt. So for our cost of equity, we want to use our formula CAPM. So that's the capital asset pricing model, whereby RF is the risk-free rate, beta is the sensitivity to the market, and then RM minus RF is the market risk premium. And I'm not going to go into this in too much depth, but you can find all of these details online. The market risk premium is essentially the spread that the market earns. So you can use the FTSE 100 if you're analyzing a UK equity. You can use the S&P 500 if you're analyzing a US equity. And then beta you can find online as well, or you can calculate using a regression. So you can do that as the company as the independent variable, and then see how much the market drives performance. There's a lot of assumptions that are made in the capital asset pricing model, and I want you to have a read of what it is before you apply it. But I wouldn't worry too much about that. It gives you a reasonable indicator of what we expect to achieve on equity. Cost of debt is typically going to be in a company's 10K statement, and it's going to be the interest that they pay on their debt, or we can observe it by looking at what their yield is trading at in the market. So we know that companies have publicly traded debt securities, and you can typically find out the coupon or the yield that they're paying on that debt, and we can use that as their cost of debt. And then the final hurdle in calculating the weighted average cost of capital is we're going to use the capital structure. So how much are they financed in terms of equity, and how much are they financed in terms of debt? And then you've got your formula to calculate that there. And I should mention that I've released a template in the chat, so you don't need to worry about coding up all of these formulas into Excel. I've already done that for you. So finally, we want to bring all of this together, and we want to account for the fact that we're the equity holder. So recall that enterprise value is the total value of the firm. So in order to arrive at the equity value of the business, we need to remove the value of the debt and then all of the other claims on the business. So I'm going to take you through this line by line. Net debt is the total amount of debt that exists, and we want to deduct the cash, since that's something that we can immediately use to pay down this debt. Minority interests are other investments in the company. So since somebody else owns it, we aren't entitled to it. Finally, financial investments are investments that the business are invested in and they may hold. So since we own a portion of the business, we are also entitled to this. So we want to add that back. So this brings us to our equity value, which is, as a shareholder, what are we entitled to? So once you've arrived at this figure, all that's left to do really is to divide by the total number of shares that exist and calculate what we believe one share is to be worth. Okay, so finally, I want to round all of this up and go back to a high-level overview again. So we forecasted our money from operations down to the operating margin. And then the amount of years that you make that forecast is going to be dependent on the kind of business. So if there's a major event that you're thinking is going to affect your thesis a lot, you probably want to include that in your cash flow forecasting. Then we accounted for all of the other things that you would need to run your business to take us down to the free cash flow. So what did we spend on property? How much tax did we pay? What money do we need to keep running our business to arrive at free cash flow? After that, we figured out a residual value of the firm to deal with the idea that the company is not worth nothing after our X years of forecast, and we don't really want to forecast the company 80 years into the future. Then we looked at those two components, and we adjusted them for the idea that the money is worth more now than it is in the future, using the weighted average cost of capital. And then finally, we took our enterprise value, which was the sum of those discounted cash flows and our terminal value. And then we adjusted it for the fact that we're the equity holders. So we removed the debt, added back the cash, and then added back minority investments. So thank you for listening. That's all I wanted to mention today. The template is going to be in the Slack channel, so take a look at that. And you're welcome to add other tabs. There's an assumptions box in the bottom. So I've just added an EBIT margin, so it gives you a nice high-level overview. But you're welcome to feed other inputs into the assumptions box, so you can make it as complicated as you like, or you can keep it as simple as you like. And I think a useful exercise will be to, once you arrive at your valuation, ask yourself, is it realistic? Make sure your numbers are right. So if the balance sheet or income statement, if the income statement is in thousands, make sure you've reflected that. And then look at the contribution towards the total value in terms of cash flows and terminal value. And then you can do some kind of sensitivity analysis. You know, if I change my multiple by this is going to happen. Or if I change this assumption by this, everything else held equal, this is going to happen. And that's a useful way to go through your analysis, and you can use it to kind of get an idea for what contributes to the market price. So I want to pass it over to questions. If there's anything that I didn't make clear or anything you want to ask Ken, please do let us know now.
If there's no questions, I just want to say thanks for listening. And just to go back to Matthew's question, it's a good point. And I'll link a few of the resources I read and put them on Slack if you want to check that out. But with that, yeah, I think we'll call it there. And thanks for joining, guys.
Yeah. Okay, great. Sorry, was that a question?
No.
Okay, perfect. Thank you all for joining us. We've actually recorded this presentation, so you'll be able to watch it back as well.
Okay, brilliant.
Okay, thank you. Bye-bye. We look forward to hearing from you.